So good morning, ladies and gentlemen. I'd like to welcome you all here to our press conference for the launch of our quarterly bulletin for the third quarter of 2015. Sitting beside me here is Gillian Phelan, who is the head of the Monetary Policy Division in the bank. And to my right, we have John Flynn, who is in charge of the Irish Economic Affairs Division. And I'm Gabriel Fagan, Chief Economist of the Central Bank. So what we propose to do is to start off with a brief presentation of the main contents of the bulletin, and then we will open the floor for your questions. So if we start, Gillian will begin by outlining the international environment.
Hi, good morning. So as usual, I'll start with a brief introduction of developments in the international environment with a particular focus on developments in the euro area. So the latest data for the euro area point to a continued, ongoing, broad-based but fairly moderate recovery in the first quarter of the year. And survey results up to June were in line with continuation of this trend in the second quarter of the year. However, there are a number of downside risks to this outlook. Meanwhile, in terms of inflation, rates remain relatively subdued. It's still too early to confirm a turning point in underlying inflation, though it could be argued that troughs or even turning points can be seen in some of its components. Finally, turning to monetary policy, the stance of the euro area remains accommodative in an environment of uncertainty and subject to financial market and confidence shocks. There is tentative early evidence that it has contributed to improvements in confidence, provided support to economic growth, and encouraged credit expansion. So starting with a look at the data on the growth, on euro area growth. Real GDP growth has been confirmed at 0.4% quarter on quarter in the first quarter of 2015. Of the big four euro area countries shown in the chart on the left-hand side, growth was strongest in Spain. Italy and France recorded stronger growth than expected, while Germany growth was less than expected. From the chart on the right, we can see that domestic demand, particularly private consumption, is the main driver of the modest recovery in the euro area. But a recovery in investment is also expected to pick up some pace as a result of more favourable financing conditions and the lower energy prices. By contrast, growth in exports has slowed to 0.6%, with imports growing to 1.2%, and this is resulting in an overall net drag on growth. In terms of the downside risk to the growth outlook, labour markets are still very weak. Employment has risen slightly in the first quarter, but unemployment levels are unwinding only very slowly. Further downside risks include a possible reversal of recent energy price trends, as well as lower than expected global growth and a deterioration in the economic and fiscal conditions in Greece. So moving on to look at the price developments in the euro area, annual headline HICP inflation has remained subdued in 2015. It has decreased slightly to 0.2% in June from 0.3% in May. But looking beyond movements in individual months, the overall direction of growth has been an increase in inflation. Nonetheless, there's still uncertainty whether this kind of uptick implies a turning point. But there are some drivers of a possible upturn. A number of drivers have appeared. So the first of these, long-term inflation expectations, both survey-based and market-based, both of these measures have been moving up. In terms of the components of inflation, we can also see some possible evidence of turning points. The decline in HICP excluding food and energy is masking two different developments at the moment, shown on the chart on the right-hand side. On the one hand, services inflation has declined again to a historical low, but this is mainly a result of some technical factors. On the other hand, non-energy industrial goods inflation has increased for the fourth consecutive month, and this is reflecting an upturn in one of the more stable components of inflation. And in particular here, there was a growth in durable goods. And also, the share of items with negative or low inflation in the basket has continued to decline in May from its peak in January this year. So just very briefly looking further ahead at the latest OECD growth projections for this year and next for the major economic regions. At the global level, latest surveys suggest that the global economy has resumed a modest but quite uneven recovery. Projections point to a rebound in activity in the US and the UK towards 2016, while the Japanese economy is more likely to see a gradual pace of recovery. The overall risks to global growth are tilted to the downside, mainly as a result of the weakening of the medium-term outlook for emerging markets. Forecasts had shown some stabilisation in the outlook for China, although the recent equity market correction has increased uncertainty here. Overall global inflation is also projected to remain modest up to the end of 2016 at least, And this is true across many advanced and emerging market economies. And finally, just to finish by looking at some very tentative evidence on the impact of the ECB's non-standard monetary policy measures. It's still too early really to measure the success or otherwise of the programme, given the long and variable lags through which monetary policy operates. However, there are some indicators that show that it is having an impact on medium to long-term inflation expectations and will help to boost inflation back towards the target of 2%. The first effect was felt via the exchange rate. So the chart on the left-hand side shows that the pass-through of the exchange rate to underlying inflation has probably begun. The impact is mainly visible in the earlier stages of the pricing chain, with import prices for both consumer goods and intermediate goods increasing strongly in recent months. On financial markets, there's also evidence of an impact. Here in the chart on the right-hand side, we can see increased demand for sovereign securities is likely to place downward pressure on their yields, with yields reaching historical lows across a range of maturities. However, developments through June in response to the uncertainty regarding negotiations in Greece have reversed some of these trends, and this is combined with a variety of technical factors that are contributing to the recent volatility. Overall then, at the moment, there are too few observations to conduct an in-depth analysis of macroeconomic effects. But as the data becomes available, the bank will be estimating the impact, drawing from the range of international literature available on this topic. So at that, I'll pass you over to John to take you through the developments in the domestic economy.
Thank you, Gillian. That's great. Thanks. So just to move on to the domestic economy then and the outlook for the economy. The main message from our new forecasts is that the recovery of the economy continues to strengthen and to broaden out. And we expect this strength to be maintained over the forecast horizon, so over the remainder of 2015 and 2016. While exports were an important driver of growth in the first half of 2014, since then domestic demand has come to play a more prominent role. On the domestic side, strong investment growth, which has been there for some time now, has been supported by a recovery in consumer spending. And while that recovery in consumer spending is still modest, it is showing signs of gradually strengthening. The pickup in consumption has benefited from continued employment growth, particularly full-time employment growth, which has boosted incomes. And while we don't yet have national accounts data for the first quarter of this year of 2015, if we look at high-frequency data such as retail sales, tax data, labour market data, they all suggest that the domestic side of the economy has continued to grow solidly in 2015. And this suggests that the momentum of domestic demand has been maintained in the first half of this year. On the external side, the available monthly data that we have suggests that some of the issues in around contract manufacturing have continued to have an impact in the early months of the year because import and export growth rates remained high. However, more recent monthly data that we've seen, particularly say if we look at what's been happening in terms of industrial production, suggests that some of this effect may now be dissipating. And what we expect is that exports will go back to growing more in line with demand in trading partner countries, sort of over the remainder of this year and into next year. So overall, our assessment, and I'll go into the detail in a moment, but overall our assessment is that the growth of the economy remains strong, and really there are three factors at work here. That's supported by the strength of domestic demand, it's supported by a broadly favourable external outlook, and by supportive financial conditions. Now looking ahead in 2015 and 2016, as I say, we expect strong growth to be maintained, and increasingly growth will come to be driven but more by domestic factors. So looking in some detail at our numbers there, so if we look at the slide there, which kind of shows the detail of our growth forecasts for this year and next, our latest forecast for 2015 is for GDP to grow by 4.1% this year, and that's 0.3% higher than our previous published forecast. The main reason for the upward revision comes from an improvement in the outlook for domestic demand. So looking ahead, further increases in employment, rising real disposable incomes, and a sort of a general ongoing improvement in consumer confidence should support a pickup in the growth of consumer spending. and we project that to rise by 2.3% this year. Now, while the high level of household indebtedness will still remain something of a headwind to a strong recovery in consumption, the outlook for this year essentially is for consumption growth to be double that of what it was last year. Now, in addition, growth in investment spending, if we abstract from the volatile aircraft component, is forecast to continue to grow strongly this year as well. And this will help to bring the share of investment in GDP, which had been pretty low for a long time. It will help to kind of continue to bring that back towards its long-run average. Now, I point out that the investment forecasts here come with a pretty strong caveat, because we're about to see the announcement of a change to national accounts methodology to include the aircraft owned by Irish Resident Leasing Company in the national accounts, and this will mean that aircraft owned by Irish Resident Leasing Companies will be included in the investment figures. So that gives some risk to our investment forecasts. Now, the inclusion of these aircraft will also lead to a corresponding increase in imports. So the same caveat essentially applies to the forecast for imports. So while these changes introduce a degree of uncertainty kind of with respect to those components, the fact that they're offsetting means that they should offset in terms of their impact in GDP. So net terms for GDP, there shouldn't be an impact. But clearly the fact that imports have gone up means there will be a change to balance of trade and will be a change to current account as well. And in time then to the ongoing flows from the income associated with the leasing of the aircraft over time, which will flow into the current account over time. As regards exports, while the issue of contracted production complicates things a little, as I say, our assumption, and tentatively there's starting to be signs of this, is that the projections assume that exports will go back to growing more in line with demand in trading partner countries. So helped by trade links with the US and the UK and signs of things, the outlook for the euro area as well, this will continue to generate reasonably strong growth in exports going forward. So overall, while the outlook for export growth remains strong in terms of net contributions, it's going to be the domestic side, which is going to be the main driver of growth going forward. So it will be the stronger outlook for consumption and investment, which will contribute more, and that we expect domestic demand to be the main driver of growth going forward. Now, although the recovery has broadened and gained momentum, so far inflation has remained relatively subdued, and the lagged impact of oil prices is the main factor kind of operating there. So our kind of on the basis of prevailing futures prices, headline inflation is projected to remain relatively subdued in 2015. If we look at 2016, then our view is that the outlook for next year is broadly similar to 2015. We now see GDP growing by 4.2% in 2016. That's 0.5% higher than our last projection. And again, the main reason for that is for a stronger domestic demand outlook. So we expect to see kind of a continued improved performance on the domestic side of the economy. Growth in consumer spending is expected to kind of remain growing at a similar pace to this year, and investment to pick up as well. And that's supported by the outlook for kind of continued growth in employment and further improvement in incomes. Export growth is projected to remain relatively strong as well in 2016. Headline inflation moves up slightly on the back of the kind of base effects from this year, but essentially we don't see much by way of underlying inflation pressures. So just finally to say a little bit about the labour market. The recovery in the labour market has been ongoing for a number of years now, and recent quarters have seen fairly strong gains. The data tell us that employment's grown by well over 2% over the past year, and overall the level of employment is almost 6% higher than it was at the trough kind of reached in 2012. Unemployment rate has also fallen as well, and we're now looking at the unemployment rate currently being below 10% haven't been as high as 15%. Encouragingly, employment growth has broadened out, and it's broadly based across the private sector. Employment is growing across most sectors at this stage. As well as that, encouragingly also, employment growth has been driven by the growth of full-time employment, and that's tending to support earnings growth as well. Looking ahead, kind of with the current trends for the economy favourable and supported by the improved outlook for domestic demand, which tends to be a bit more job intensive, we forecast employment growth to average kind of 2.3% or so this year and next. And that should tend to push down the unemployment rate further. So our forecast for the average rate for this year is 9.7 and 8.5 for next year. But obviously, end-year rates we expect to be lower than that. So that's the broad outlook then. And as I say, it's for continued strength in the recovery really going forward. So I'll pass to Gabriel now.
Okay. We have the policy, fiscal. Okay. Thank you very much, John. So I will just briefly present some of the main policy messages in this quarterly bulletin, and we have two broad topics. One relates to the public finances, and the other to the, if you like, the banking, household finances, and so forth. So in regard to the public finances, I think we have to acknowledge, of course, first of all, that there really has been very substantial improvement in the fiscal position. The debt ratio is down from a peak of 124% of GDP to an estimated 105% at the end of this year. So really, really very substantial improvement. A lot of this, most of this improvement in its way is attributable to decisive policy actions by the authorities. Most recently, however, we're also seeing that the public finances are benefiting from robust economic growth, and that is very clearly evident when you look at the exchequer returns. So looking ahead then, the question is where should fiscal policy be going? So of course fiscal policy is a matter for the government, but the central bank, as part of its mandate, its statutory mandate, is required to give independent advice. So when we start looking at the fiscal position, we basically focus on it from two perspectives. One is fiscal sustainability, ensuring that the path of debt deficits is sustainable over the longer term, or the medium term, the longer term. And the other perspective that we take into account is what you might call macroeconomic stabilization. So how can fiscal policy contribute to the overall stability of the economy? Now, if we take that perspective and these two perspectives, when we look at the issue of sustainability, what we would say here is that there is, given the prospect, or indeed of faster growth than has been expected, this obviously has favourable implications for the public finances. So that creates an opportunity to engage in a more faster pace of fiscal consolidation, a faster reduction in the debt ratio that is there. And we would suggest there may be some consideration given to this. The main focus of the fiscal rules in Europe and domestically are on fiscal sustainability, and as we know, Ireland has exited the excessive deficit procedure, or will exit this year, and will enter into the preventive arm of the Stability and Growth Pact, and this has the requirement that there should be an adjustment of at least 0.6 percentage points of GDP in the structural balance. But of course, that is sort of a minimal requirement to meet the rules. There's nothing to stop the authorities outperforming that goal. And what certainly looking at the analysis from our perspective, bearing in mind that while great progress has been made, debt ratios are still quite large and the fiscal position remains vulnerable to adverse shocks. So we would tend to put forward the idea that consideration should be given to the idea of a more rapid pace of fiscal consolidation, a more ambitious fiscal than just meeting the minimal rules that are required by the Stability and Growth Pact. Now, on the issue of stabilization, I think if you do the economic analysis, you look at what's going on in the economy. You have an economy that grew by nearly 5% last year, is expected to grow by in excess of 4% this year and next year. We are witnessing a decline in unemployment, which, as John has highlighted, is quite notable. And also we have, if we look at various measures of slack in the economy, so-called output gaps, these measures are not pointing to a very large negative output gap in the economy at this moment in time. So from this perspective of macroeconomic stabilization, there is really no need for a fiscal stimulus in the economy at this point in time. So it may be worth, we would argue, the idea would be to maybe build fiscal space for a time when it might be needed. If we have a situation where there's an adverse shock, fiscal policy can respond. And this can be brought about by having this somewhat more ambitious pace of fiscal consolidation. The other point on stabilization, of course, is that we've seen in the past the damage that is done to the economy from pro-cyclical fiscal policies, policies which is expansionary during good times and contractionary during bad times. We should try to avoid repeating that in the future, and that would argue in favour of a cautious approach to fiscal policy over the next few years. Now, thanks. Turning to the financial situation of the banks and their borrowers, I think it's clear that when we look at all the available indicators that we have, these conditions, financial situation of these entities is improving. If we look at the households, we see that household debt has fallen from around a peak of 180 billion to 157 billion in the latest data. The increase in house prices that we have seen has also served to raise the value of the assets on the asset side of the household's balance sheet. So we have seen an increase in the net worth of the households taking place since quite a number of quarters. It's also notable that the situation with regard to, say, for example, negative equity has improved quite a lot. The numbers, according to the SRI, the numbers in negative equity has halved since 2012, the number of households from a peak of 300,000. And our own analysis in the bank sort of confirms this favourable picture with regard to the evolution of negative equity. I would point out now that we will publish shortly in the next few days or weeks, early August, our household credit market report, and that will incorporate a lot of analysis of this kind, so I would draw your attention to that. Regarding the banks, again, the indicators are broadly positive. We've had a very successful conclusion of the comprehensive assessment. The two major banks have already returned to profitability, helped to a considerable extent by reductions in impairment charges, and also reflecting improvement in financing costs. It's also notable that the banks have been able to raise funds on capital markets at relatively favourable rates more recently, and we have seen some rating upgrades. So overall, the position of the banks themselves is improving gradually over time. It's also worth noting that we have taken earlier this year macroprudential measures with respect to residential mortgage lending, which we believe is a timely intervention in the market which will help to forestall future risks to financial stability, such as what we witnessed during the crisis. Now, there is a sort of remaining issue, if you like, hanging over the element, and that is the fact that while the stock of NPLs is falling, the overall level is still high. So we've seen arrears rates for primary domestic dwellings, primary dwelling houses fall from a peak of 17% to 14%. And we've also seen quite a number, 117,000 restructures of mortgages, of which 85% are meeting the terms of the revised agreement. So we have seen quite an improvement there, but still the level is high. The level is high by international standards and, of course, by the standards of the pre-boom period in Ireland. A notable element on mortgage arrears, of course, is that while the overall level of arrears is falling, we have seen some increase in arrears of longer maturity. So we have the group which is greater than 720 days past due. That has increased somewhat. It's up now from 21,000 in September to around 38,000 in terms of number of loans. Fortunately, whilst it is still increasing, the rate of increase is actually declining. Now, to address those, it's worth noting that the mortgage arrears resolution targets, MART as it's known here, this process has come to an end, and it's come to an end relatively successfully in the sense that the targets that were set. And these were very broad targets for all institutions, the same sort of targets, broadly speaking. These targets have been met in terms of a number of restructures which have been proposed to borrowers, and also the number which are concluded. So the latest statistics point to, broadly speaking, this process being a success. As we go forward, it's no longer deemed necessary or useful to go along with such broad brush measures. We also have to bear in mind that, of course, since last year, we are part of the single supervision mechanism, so that what we are doing here has to be consistent with what's being done elsewhere within the euro area. So what is now taking place is a shift from these broad targets to much more finely balanced, granulated analysis, so where you focus on banks, different banks, because the situation varies across banks, and also looking at different classes of borrowers, particularly focusing on the more distressed borrowers. So that is the main policy conclusions. Let me now hand over to John, who will bring you through the signed articles in the bulletin.
Thanks, Gabriel. So on this occasion in this bulletin, we have 3 articles, and I'll just say a little bit about each of them. And we have the authors, some of the authors here with us today. So if you have questions on any of these articles or any of the topics covered, we can take them as well. So the first article I'll mention is an article entitled Labour Cost Adjustment During the Crisis, Firm Level Evidence. And this article introduces a new firm level data set that the bank has been involved in collecting. It's based on the results of a survey of wage setting practices of Irish firms, and it was undertaken as part of the work of an ECB network. So it's part of a kind of a cross-country look at this issue across Europe. The survey results allow for a firm level analysis of the approach taken kind of to labour market adjustment during the crisis period. And a number of the findings are probably worth highlighting in relation to the results of the survey. So in terms of the labour cost cutting approach taken, firms relied upon both reductions in the quantity of labour, so that is both in terms of employment and hours worked, and also the price of labour, that being wages. So employee numbers were cut most widely, employee numbers were the most widely relied upon kind of measure taken, followed by wage cuts and hours. What the results of the survey show in Ireland's case is that while the majority of firms opted to freeze base wages, that there was strong evidence, there is strong evidence of downward wage flexibility, with around 1/4 of firms in the survey reporting that they cut wages in this period. And a comparison with previous findings in relation to Ireland and other euro area countries, because we undertook this survey previously in 2007, points to an increase in the incidence of wage freezes and wage cuts among Irish firms during the 2008 onwards period. The second article then that I'll talk about is an article entitled Data Gaps and Shadow Banking, and it profiles special purpose vehicle activities in Ireland. There has been a focus on the role of shadow banking and securitisation, kind of a growing focus since the start of the global financial crisis in 2007. And Ireland has a sizable non-bank financial sector with a number of key components. So we've got money market funds, investment funds, and other financial intermediaries. And this article examines the activities of financial vehicle corporations and special purpose vehicles registered in Ireland. So it gives an overview of the sector and then notes some of the issues that arise. So there are approximately 1,300 financial vehicle corporations and SPVs registered in Ireland, or as of 2012. And the main point, I suppose, that emerges, and one of the main points that emerges, is that the financial vehicle corporations and special purpose vehicles have limited direct links to the domestic economy, but are connected to the wider global financial system, as the majority of their assets and liabilities are located outside of Ireland. These vehicles engage in a diverse range of activities and do have interconnectedness across the banking sector. And in order to better assess the impact of this sector, the bank is proposing to extend its reporting requirements in this way. So this sheds some light on that as well. And then the final article then is an article, essentially an explainer article on the euro area expanded asset purchase programme. So the article sets out to explain the what, why and how of the ECB's expanded assets programme, I suppose, which is commonly referred to really as quantitative easing. And it looks at the reasons behind the decision to introduce the programme, the details of how the programme will be carried out, and in broad terms, the channels through which the programme is expected to affect the real economy. So there are a number of different possible channels. Now, the article doesn't attempt to draw firm conclusions about the effects of the programme because we're still at an early stage and there isn't a lot of data available there to analyse. So, but it sets out in a kind of an explainer way, kind of essentially how the programme is set up and designed and how it is intended to operate. So, as I say, we have some of the authors here for all of these. So, again, if there's any questions that you want to ask, we can take them. So, thanks.